I'm glad you guys are back. Chapter 18 is jam-packed full of formulas and concepts that are really important. Today, we're going to spend most of our time reviewing a lot of what we covered last time and probably spend the vast majority of our time getting our hands dirty, working out problems and solutions. Of course, you guys are always encouraged to ask questions as we go. Okay, then here's our agenda, and you'll notice that our agenda today is basically recapping what we focused on in day one. The major focus of this chapter is this contribution margin concept and how we can use that to calculate break-even points. We can use it to construct break-even point charts. We can use it to answer a whole bunch of what-if scenarios without having to go through the hassle of doing new income statements every time. You're going to see me today cognitively think through problems before we actually calculate items, because as business people, we want to get into the framework of being able to think critically, I'll call it on our toes or off the cuff as we go. We want to develop that business mindset. And so we're going to work on that a little bit. The new part today will be the break-even point for multi-unit companies. That means we know that when we walk into a store, most companies sell more than one product, right? Except for Simple Green. I can't really think of another company that only sells one product. So most companies sell a variety of products. And so we want to be able to tweak that break-even point for multi-unit companies. We'll learn two methods to do that. You'll get the same answer no matter which method you use, but in your notes, I want you to write down composite unit method, and then weighted average method. I'm going to demonstrate both to you. We'll come up with the same answer. Sometimes multiple choice questions will go back and forth between those two methods. So I want to make sure that you're familiar with both. And then this last line item, other measures, I would call these more minor topics, but still important. We'll talk about the margin of safety today, and we'll talk about leverage today. So that's where we're headed. Any questions on what we're doing or anything that you would like to see covered that you don't see on the agenda? And I did see that a few of you have finished your homework, so that's really good because this chapter can be intensive. Okay, so the handout, we usually use the handouts, and the handout's good. It covers pretty much everything. But I think rather than looking at words today, I'm going to go through, again, a portion of the PowerPoint. You guys have access to the full PowerPoint. I've gone in and just taken some slides that I want to focus on today. So we've seen this slide before. This whole chapter is about cost, volume, profit. And you notice that this first line says it's going to enable us to make predictions. Okay, that's another word for forecasting ahead of time. And so I can't think as a new business owner way back when, 30 years ago, I can't think of a chapter that would have been more relevant to me putting together a business plan to finance these businesses than this chapter. So all business plans have a component in it where you're going to be asked to calculate the break even, along with a whole lot of other things for you to assess your competition, for you to understand the economics that surround the area that you're going to be operating in. Lots of questions like this can be answered through a business plan, and all business plans incorporate the assumptions that we're using in this chapter. That's why it's a critically important chapter. Okay, because most of you, at least at the age of when I was in school, I started college at 17. So when I was in school, I had no clue that I would ever even think of opening a business. But when I got out there and saw, especially in volleyball, which my daughter plays and has played for years, when I got out there and started seeing how some businesses were operated and how much money I saw coming in, sitting around me, I thought, wow, I think I can do this and I think I can do it better. And I'd much rather prefer to bring in quite a bit of money as opposed to some kind of an hourly rate. And that's how entrepreneurs are born. So this is a really important chapter if you have any dreams or thoughts of starting a business. So you can run down the list. We saw this slide last time. What's the break-even point? What happens if we decide to automate to reduce labor costs? What if our sales price goes up or down, or we decide to tweak it or discount it? If we're selling things like hotcakes, can we increase the selling price without having too much negative effect on our business? What if we change the mix of what we sell and nobody's happy with breaking even unless it's a weird time like we see now? So forget about breaking even. What if I want to have $200,000 coming in next year? What type of sales volume would I need to do to make that happen? Break-even point is one of the formulas that came out of the cost volume profit discussion. And we learned how to calculate break-even points graphically. Now, we didn't focus on that in class, but your book focuses on graphing break-even points. I won't expect you guys to construct a chart, but I would expect you to be able to read one. For example, if I gave you a chart and I asked you, what are the fixed costs based on this chart? Would you know that that's the point where at 0 units, there is still a cost on that y-axis? So be able to interpret a chart, I would say. We know that the break-even point is exactly what that word means. It's the point where there is no loss and no profit. It's the point at which you break even. We know that it can be expressed in units or in dollars, and we've gone back and forth between the two. And then there's 3 ways to find a break-even point. We've typically been using the formula. We have used a contribution margin income statement, and your book has used cost volume profit charts to detect the break-even point. Questions on those first 3 slides? We've been pretty focused on this formula method. So if these 2 formulas are not in your notes, these are critically important formulas. The first one shows us how to do the break-even point in units, and we will review that today. And the second one shows you how to do the break-even point in dollars. Both are important. We'll be using both today. And then the author walks you through an income statement where you put in the knowns and you can always calculate the unknowns. So I'm not too thrilled on this method, but I would expect you to be able to do a multiple choice question. So you can go back and take a look at that slide and see how they solve it. The charting, here's what I was talking about on the chart. I won't ask you to construct this chart, but I would expect you that if a chart was given to you on a couple of multiple choice questions, that you would be able to read a chart. For example, if I asked you, where is the break-even point? I expect you to be able to know that the break-even point are where these 2 lines intersect. And so if I asked you that, you would say, oh, the break-even point is 800 units, or the break-even point is $80,000. Okay, here's the question I was asking you earlier on where would the fixed cost be? It's the place at where you make 0 units and the cost line crosses the dollar level. In other words, even though they're not making any units, this company still has a fixed cost. It looks like it's a little bit higher than 20,000. I'd have to be able to zoom in on that chart to know the exact amount. And if I asked you to measure profit by looking at a chart, you should know by reading that the way you would do that, let me get my pencil, you would come up to whatever level, I'm just pulling this out of the air, at 1,200 units, if you would take a ruler, you could go up and there would be the revenues and here would be the expenses and the profit would be the difference between those 2 lines. So sometimes owners and directors and officers, they don't like to see a whole bunch of numbers. They would prefer to see it graphically. That's where this comes into play. And so they could go up to the 1,800 mark here. Any place over the relevant range, they can go measure the profit by taking a look at the distance between those 2 lines. Okay, and of course, if we make under the break-even point, we could also measure our loss. You'll see the loss area is to the left of the break-even point, and the profit area is to the right of the break-even point. So just be comfortable with looking at a graph. Today, a lot of our what if analyses are going to cover what happens if we have a change in estimate. In other words, what if our selling price goes up? What effect will that have on the break-even point? Okay, cognitively, if our selling price goes up, that means our break-even point is going to go down because we're making more money with all the costs staying the same. We're making more money. That means we're going to have to sell less to break even. So as we go through these different changes in estimates today, you're probably going to see me ask you first, before we work it out mathematically, what do you expect to happen cognitively? And I would encourage you guys to do your homework that way as well. Ask yourself, okay, what am I expecting when I do this homework problem? Is my break-even point going to go up, or is it going to go down, or can I not tell until I calculate it? We'll be doing a lot of that today. And then this next one, oops, I always do that. Give me a second. I must have hit the button here all of a sudden. This is what we were looking at. So our next slide says, describe several applications of cost, volume, profit. Well, one of them, again, I consider this a minor application, the margin of safety. And the way that I try and remember this one, because I am not good at memorizing formulas. So when I see margin of safety, I think of a cushion, the margin of safety. It's the cushion I have. Another way of saying it, and we'll practice this shortly, is what kind of a loss in sales can I suffer and still not lose money? It's my cushion. It's how far above the break-even point I am. And we're going to learn to calculate that in dollars, and we'll learn to calculate it as a percent. I believe you guys have a multiple choice question, and I believe that there's a small section of a 10-point test question that will ask you to compute the margin of safety. It's a break-even question, but a little section of it will say, what's the margin of safety? So we'll be demonstrating that to you in a second. And then we already know that not everybody wants to break even. Most of us are interested in earning a profit. So we learn to tweak the break-even formula to include target income in there. And so we'll be practicing that today.
A couple of other new things that we'll talk about today is the sales mix and what happens with break-even points when we sell more than one product. We'll replace our normal contribution margin with a weighted average contribution margin. We'll probably just jump into an exercise and we'll talk more about that and work on one step by step. And then the last item we'll focus on today is the degree of operating leverage. We have a lot to do, so let's get started. This will serve as a review of what we started last time. Let's read the problem together and review the concepts of what this transformed managerial income statement looks like. It says Harris Company expects to sell 200,000 units, which would generate sales of $17 million. Management predicts that income next year will be $1,250,000 and that the contribution margin will be 25. See, I don't think that this was given to us. So use the information to compute next year's expected variable costs and fixed costs. So they gave us some information, but not all the information. So the first thing I think I'll get is the per unit selling price. That may be helpful. So I'll take the sales dollars divided by the number of units, and I came up with $85 per unit. Since they gave me the contribution margin at $25 a unit, I'll go solve for variable costs because I know that's one thing that they asked us for. So let me take the difference. I got $60 as the variable cost per unit. The other thing that may be helpful, and I'm not sure if we'll need it or not, but it's good practice, compute the per unit percentage for sales, variable costs, and the contribution margin. So I'm going to go ahead and do that. That means take each of those first three line items and divide by the sales price. We know that the sales line item will always be 100. When I take 60 divided by 85, I get 70.6%. And when I take 25 divided by 85, I'll get the remainder. Now that I know that variable costs are $60 a unit, I can simply multiply by the same 200,000 units that was used in the sale line item to come up with the variable costs. Once I have that, I can calculate the contribution margin. By the way, there's lots of different ways you could approach this problem. They should all result in the same answer. If my contribution margin's $5 million and my net income is $1,250,000, to get that last number, we'll simply take the difference. Okay, so we're using this transformative managerial income statement that's going to help us in the future with many predictions and forecasts. So if you haven't yet practiced the contribution margin income statement, this would be the time to spend reading that chapter and looking over previous exercises from the last lecture. The next two exercises are going to refer back to one that we worked on in class yesterday. In other words, we're going to take some data that we're already familiar with, and we're going to do some what-if scenarios. In the first exercise, it looks like the author's asking you about whether an advertising campaign would be worth the expected result. In the second exercise, with the same data, they're going to again ask you a what-if scenario. In the second one, they're going to raise their sales price and they want to see the effect on the income statement. I would encourage you to critically think through the answer using what you know about cost, volume, profit, and the related relationships. I want you to get out of the habit of having to create income statements every single time that an item is changed. Instead, focus on what you know about cost, volume, profit, and see if you can recompute the net income given the different scenarios. It's okay to have to do an income statement if you can't work through it mentally, but again, think of the scenario where you're sitting around a table with a group of managers. You don't want to have to wait to run back to your office and do a new income statement. We want to start thinking about thinking off the cuff, or being able to interpret the data internally and not have to rely upon a formal financial statement. So let's challenge these critical thinking skills that we've been working hard to develop and see if you can calculate net income without having to do a formal financial statement. Pause the video and let's see what your answers are. Okay, on the first one, where they were contemplating an advertising campaign, it says the manager believes that increasing advertising costs by $81,000 will increase the company's sales volume to $11,000. They want to know what's the effect on the bottom line. Okay, well, currently in the current income statement, we're bringing in $108,000. So the question becomes, should they spend $81,000? That'll be considered a fixed cost. They could increase their sales volume to 11,000 units. The way that I would approach this problem, based on what I know about cost, volume, profit, I would look at that volume increase from 9,600 to 11,000, and I would compute that 1,400 more units were being sold. I'd multiply it by the $45 contribution margin, and that tells me that there would be $63,000 additional dollars coming through the bottom line based strictly on the volume increase. So that means net income is going to go up by $63,000, and the cost of that advertising was $81,000. That'll make the net income go down. So here's the calculation that I would be doing if I were sitting in a roundtable discussion with other managers. I would tell them that this would not favorably affect net income, that net income would drop from the current 108 down to 90,000. Now, of course, you could do an income statement, and that's what the author solution will show you. It's better if you can think on your feet to be able to make these type of decisions off the cuff, so to speak, rather than having to rely on an income statement every single time. So in the official solution, you'll notice that they've calculated the sales of $11,000 at $225. They calculated the variable costs. The variable cost didn't change. They would remain at $180 each. We computed the new contribution margin. We took out the increased fixed cost due to the advertising campaign. And once again, we come up with $90,000. Take a moment to think about that alternative strategy, because I want you to get in the habit of utilizing those critical thinking skills. This related exercise talks about a selling price increase of $200 or up to $240 per unit. So that's the only thing changing is the selling price. The way I would have answered a question on what's the new net income, I would have realized that a $240 selling price is $15 above the current $225. I would have taken that increase of $15 per unit and taken it straight to the bottom line. So $15 a unit times 9,600 units would be an additional $144,000 to the current bottom line. So I would have taken the $108,000 in the current income statement, added the $144,000 in contribution margin that we just verbally calculated, and I would know that my new net income is $252,000. But we want to show you as many alternative solutions as possible. So on the screen, you'll see a new income statement with the sales price increased to $240. We come up with exactly the same projection that we just made. Take a look at that, and then we'll specifically answer the four questions that the author asked. Step number 1 wanted the new contribution margin per unit. That would go up to $60. Okay, right now it's $45. That sales price increased it to $60. You can see the intermittent calculations above. The second thing the author wanted was the contribution margin ratio. We would take that $60 in contribution margin divided by the sales price of $240, and we come up with 25%. Number 3 wanted the break-even point in units. Okay, we know that the formula for break-even point in units says take the fixed costs, $324,000, divided by the new unit contribution margin of $60 per unit. When we input that into our calculators, we got 5,400 units, and then the author also asked for sales dollars. I would take a shortcut and just take that 5,400 units times the new selling price to come up with the break-even dollars, or you could have used alternatively the author's formula, which uses the contribution margin ratio when the author asks for dollars of break-even sales. Either way, we came up with the same answer. We're taking all the information that we learned last time and tweaking it for all the different what-if scenarios that the author is going to throw our way. Here's another what-if scenario. In this case, the company is considering buying a new machine that will increase its fixed costs by $40,500 per year and decrease the variable costs. I would plan this out based on the current net income given to us at $108,000. And then I would look at the two components mentioned by your author. If the fixed costs go up, then the current net income is going to go down. So I would look at this at an increase in fixed costs, pulling the net income down by $40,500. And then I would also look at this as the decrease to the variable costs. If the variable costs go down, that means the net income goes up. By how much? By $9 a unit. I'll put savings in variable costs at $9 per unit. And right now they're selling 9,600 units based on that income statement. So let me pop that in. 9 units, $9 a unit times 9,600. That would make the bottom line go up. And so I would focus, again, think about sitting around the table with people in the company and trying to come up with what that bottom line would look like given their suggested changes. In this case, it looks like our bottom line would be $153,900. I would verify it by following the author's suggestion and completing a new income statement based on the new set of facts. I'll pause the video and come back and show you that new income statement in a moment. Here's proof that our critical thinking answer was right on target. In this case, we changed the variable costs. We decreased them by $9. So on this line item, you'll see the variable cost extended out. We also increased the fixed cost by the cost of that new machine. And as we suspected, the resulting net income was indeed $153,900. Let's keep on going. This next exercise is a little bit trickier because now they're going to be talking about two different variables changing. Oftentimes, the items given to you will work in opposite directions. So I attack this exercise by focusing on the old net income of $10,000 and adjusting it for each of the various factors that came into play. I would encourage you to try the exercise first with that approach. And again, we're working on developing those critical thinking skills so that you don't have to run back to your office to do a formal income statement every time. So try it out using that approach first. And then to verify your answers, go ahead and create the 3 different income statements based on the different factors changing, implementing these various business strategies. And then let's come back and compare our answers. I will tell you that one of these 3 was fairly challenging to think through the multiple causes of how the costs changed. Check it out and let's compare our answers. My approach is shown off to the right-hand side. On the first one, units produced and sold increased by 400 additional units. So I took a look at what the volume change would do to the net income, in addition to what the fixed cost increase would do. The volume increase pulled net income up. The fixed cost increase pulled net income down. My approach on number 1 came up with a new net income of $6,600. Approach number 2, off to the right, started off with a unit selling price decrease. When you decrease the selling price, that causes net income to go down. And in addition to that, it reminded us that the unit increase has both a sales and cost impact. So that was a reminder that we can't look at this in a vacuum. Take a look at the newly revised net income of $7,800. Notice both of these were not an improvement over the old $10,000 in net income. And then number 3 on the right-hand side was a little trickier. The fixed cost increase wasn't the hard part. We know that when fixed costs go up, net income is going to go down. The tricky part was the variable cost decreased by 2. Okay, that's going to cause the net income to go up as well. But then the units produced and sold went up by 500. To avoid double counting that $2 per unit decrease, there was a little bit of tricky math that happened at the bottom there. And notice number 3 was the only one of the 3 scenarios which wound up with a higher net income than the original. So again, take a look at the approaches off to the right. If you want to just follow the concept that the author provided of redoing income statements every time, that will work when given the time opportunity. Doesn't work real well in roundtable discussions if you have to tell your colleagues that you'll have to go run to your office and make an income statement. So either way will result in the same answer. So let me scroll through to that third one and assess how well you did. Do you understand how cost, volumes, and profit are related? Let's move on to the next topic. The next topic we talk about is going to be what we call multi-product cost volume profit analyses, specifically as it relates to the break-even point or the target profit point. So I want to read this exercise with you, and then we'll go take a look at the PowerPoints related to multi-product analysis, and we'll come back having reviewed the lecture slides, and we'll work out this exercise that deals with windows and doors. For companies that sell more than one type of product, the sales mix is important. The sales mix is the proportion of sales volume for each product. For example, if you sold 25 footballs and 75 baseballs, you would have a ratio of 25 to 75. Another way of saying that is 1 to 3. So we're going to use the break-even formula and our target profit formulas and tweak them a bit by weighted averaging back the sales mix. It'll become much more clear when we try one out. The same break-even formula where we take fixed costs in the numerator and the unit contribution margin in the denominator will be tweaked to include the contribution margin multiplied by the sales mix percentage. In this case, with the footballs and basketballs, the ratio, the weighted average ratio that we sell these things in is 60% footballs and 40% basketballs. So on the denominator, the $30 contribution margin is weighted by 60%, and the basketball contribution margin is weighted by 40%. You'll see the formula in the gray box on your screen, but once again, it's going to be much better to just go through one and work it out. When the fixed costs of $48,000 are divided by that weighted average contribution margin of $32, we came up with 1,500, what I've heard referred to as enterprise units. The thing is, we don't sell enterprise units. We sell footballs and basketballs. So the last step of this would be to break out that 1,500 units into footballs and basketballs by multiplying by the given percentages of the sales mix. Let's try one for ourselves. Okay, let's get our hands dirty and try one of these sales mix problems. This problem tells you that this company sells windows and doors in the ratio of 80% to 20%. We're going to tweak our break-even formula. We'll still have fixed costs on the top. We're going to use a weighted average contribution margin on the bottom. That means we're going to calculate the contribution margin of these two products and then weight them according to the 80%, 20% sales mix. The second sentence tells us that the selling price is $200 on the windows and $500 on the doors. It tells us that the variable cost is $125 and $350. So by taking the difference, we will have the contribution margin for one window and the contribution margin for a door. Let me try that again. That looks better. I'm going to copy that down with the same formula for the doors. And now we can take our contribution margin and appropriately weight it. Fixed costs are given at $720,000, and here's where the new part comes in. We're going to take that $75 contribution margin and we're going to weight that by 80%. That would be for the windows. And then we'll take $150 contribution margin and weight it by the other 20% for the doors. Let me put my dividing line in, and let me go calculate those two parts of that formula. So $75 at 80% would give me 60, and 150 times 20% would give me 45. I'm gonna, that doesn't look right. Let me try it one more time. 150 at 20%, that looks better, would give me $30. And when I add those two up, I have a weighted average contribution margin of $90. Let's go ahead and put that in the calculator. The fixed cost of $720,000 divided by the weighted average contribution margin of 90 gives us 8,000, for lack of a better word, and I didn't see one used in the book, enterprise units. The problem is we don't sell enterprise units. We sell windows and doors. So I'm going to weight this back by 80% on the windows and 20% on the doors. And when I take that 8,000 times 80%, my break-even point with that given sales mix would be 6,400 windows, and once I do the math, 1,600 doors. So there's our break-even point based on the windows and doors that we sell. If I wanted to turn those into sales dollars, and I'm not sure the author asked you to, but if you needed to turn those into sales dollars, the easiest thing to do is just multiply by the sales price. So even looking back over here, my sales price on the windows were $200. My sales price on the door was $500. When I do the math, we would have break-even sales dollars of $1,280,000 on the windows. And based on that sales mix percentage, that would give us $800,000 in doors. For some reason, they asked you for total sales at the break-even point. You could simply sum those blue numbers up. So expect to see a problem related to multi-product break-even points, and try the next exercise, which I'll display the answer to momentarily. For extra practice, let's try one more multi-product company. In this case, it's a tax return company that does easy, moderate, and then business returns, which are usually a little bit more difficult. They gave you the revenues and the variable costs. So the first thing I would do on this one is I would calculate the contribution margin for each type of tax return. Once you have that, you're going to weight it by the appropriate sales mix that you see in this column, and we'll use the modified break-even formula, which says fixed costs go on the top and the weighted average contribution margin would go on the bottom. So take each one of those contribution margins that you compute, multiply it by the sales mix to get the enterprise break-even point, and then weight it back to get how many easy returns, how many moderate returns, and how many business returns you would need to sell with that sales mix to break even. Here's your answer. The fixed cost should have been divided by the $60 weighted average contribution margin. The enterprise units would have been 300, and when you split it out using the 50%, 30%, 20% sales mix, you would have come up with 150 easy tax returns, 90 moderate tax returns, and 60 business tax returns. Once again, take it the extra mile and make sure you know how to turn that into sales dollars. Let's move on to our next topic. Cost volume profit is especially useful during challenging business conditions when management wants to predict income based on alternative strategies. Management is usually interested in seeing the effects in some or all of the various factors involved in cost volume profit. A useful measure to assess the effect of changes on net income is the degree of operating leverage, as you see on the screen. It's the contribution margin on top divided by the net income on the bottom. And as the blue box states, it's a measure of operating leverage. I think the best example is to once again get our hands dirty and compute one, and then talk about what the results mean. In this example, the contribution margin is shown at 36,000 and the net income is at 12,000 at 1,200 units of activity. This equates to a degree of operating leverage of 3. What that means is if they were able to increase sales by, pull the number out of the air, 10% in the author's case, they would see a net income increase of 3 times that, or 30%. The author then proves it to you by increasing the sales from 12,000 up to 132,000. And as you can see, that net income in the middle there did rise by 30%. So the degree of operating leverage is really helpful when viewing what-if scenarios. Take a moment to check it out and make sure you understand at least the bare basics about what leverage is. I would consider this a minor topic on our upcoming exam. Degree of operating leverage is computed for Skittles and Starburst. That's all I needed in the middle of a busy day, is to be tempted by candy. But in any case, when you take the contribution margin and you divide by the net income, you see that Skittles has a degree of operating leverage of 3.6 times, and Starburst has a degree of operating leverage of 1.5 times. What that means is if the company had a sales increase of 20%, then the net income would go up by 72% for Skittles. For Starburst, a 20% increase in sales should yield a 30% or 1.5 times multiplier greater in their net income. What that boils down to is that even though Skittles' fixed costs are higher, its percent increase in income is greater than for Starbucks due to its higher degree of operating leverage. Let's move on to our last few problems. I think this is a great problem to assess yourself on whether you understand the basics of this chapter. There's a whole lot of information in this chapter. In fact, had I been the author, I probably would have broken it up into 2 chapters. There's that much information. And remember, we're only covering the bare basics. So let's read this together and then I'll present the solution to you. It says Rivera Company sold 20,000 units. Okay, that's important. Look at that income statement below. And reported net income of 20,000. Okay, they are breaking even. In fact, they are above breaking even. During a planning session for next year's activity, the production manager notes that variable costs can be reduced 25% by installing a machine that automates operations. Okay, this is common. Companies are looking for a way to cut down on their product costs, and this company is looking at a strategy where they're going to spend a significant amount of money, if I remember correctly, $113,000, in the hopes that they can reduce their product costs by 25%. They want to know, what is our bottom line going to look like? The selling price will not change. So the author asked you to do several things. He asked you to compute the break-even point for next year, assuming they go ahead with purchasing that machine. They ask you to do a contribution margin income statement for next year that shows the expected results of the machine installed. They want you to assume that sales will be $750,000. So that sounds like a contribution margin income statement. And then finally, they're not happy with breaking even, and they're not even happy with the current net income. They want to know, can you do a target profit point? That company's going to earn $87,000 of target income. So again, great review of the chapter. If you can compute these items, you have a pretty good understanding of cost, volume, profit. So first thing author asked for was the break-even point in dollars if the new machine is installed. So we took the current fixed costs and added in the cost of that new machine, and we got $243,000. And we divided by the new contribution margin ratio. I calculated that for you right here. The selling price was going to remain the same. They were going to have a decrease in the variable costs, and that would have changed their contribution margin as well. So that 40% contribution margin ratio came from right here. So the amount of break-even sales, if the new machine is installed, jumps to $607,500. The contribution margin income statement at a $750,000 level of sales results in a net income of $57,000. You can compare that to the old net income. How we got that was by using the percentages here. If the contribution margin was 40%, automatically the variable costs are the opposite at 60%. And the fixed costs we computed in number 1 above. When we put that managerial income statement or contribution margin income statement together, the company would generate a profit of $57,000. But they're not happy with that. They ask you to do a target profit point. And the target profit point here is the combination of the fixed costs and the $87,000 in profit. Numerator results in $330,000. And the contribution margin ratio, the new one of 40%, is on the bottom. To generate that type of a profit, this tells us that the company needs to earn $825,000 in sales dollars. If he wanted units, the quick way to convert those sales dollars to units would be to divide by the sales price. And this was a good application of cost volume profit. Alternatively, I would have approached this a little bit differently. Rather than having to go back to my office and do a new income statement, I would have started off with that old net income. I would have brought it down by the change in the fixed costs, and I would have added in the effect of the changed contribution margin. It doesn't matter which way you decide to do it. I just like to learn how to think on my feet. And so no matter how you decide to calculate that, the new net income above was $57,000. It's been a long chapter. The last exercise was meant as just additional practice on a multi-product mix strategy. So I'll flash the answer for that last one. And I'm proud of you for hanging in there on this really tough chapter. Try the exercises and problems earlier in the week so that you can reach out to either your embedded tutor or to myself to get any help that you may need. Let me show you the last problem and then we'll call it a day. Here's the answers only on this last break-even analysis with multi-products or more than one product. Break-even point was the first thing they asked you to compute. Based on that weighted average contribution margin of $26, the break-even point in enterprise units was 20,000 units. They split that out based on their sales mix, resulting in 12,000 small items and 8,000 large items. They then revised the set of facts with some new information that came in. So you had a revised break-even point at 19,000 enterprise units, for lack of a better word. Split out, it came out to 11,400 small and 7,600 large. If there's any questions at all, make sure you reach out. To wrap up this chapter, make sure that you're familiar with the assumptions that go along with cost volume profit analysis. Costs can be classified as either variable or fixed. It's important that the costs are classified correctly or incorrect forecasts will take place. There's no place for mixed costs in cost volume profit analysis. So if they do occur, remember we've learned tools to separate out the costs between variable or fixed. Another assumption is costs behave in a linear manner and are within the relevant range. Another assumption is the units produced are sold and that inventory is constant, and that the sales mix is constant when we deal with more than one product. There's a lot of material. I would encourage you to put an extra time block of study into this chapter. This is Professor Johnson signing out.